Today.
Good.
What's up, Benny?
What's going on, guys? Brendan, we playing tennis today?
If it don't rain, I'm in.
All right, cool. So the reason why I wanted to do this, and I spoke to Brendan about it, is because I feel like this could add a lot of value to everybody. Isaiah and Lenzai both reached out to me and thought we could help out a lot of people as well in regards to investing. So we figured we would just get down to the basics today about background information, about opening a brokerage account and going from there. So I can tell you a little bit about what I've learned, and then Brendan's going to get into his stock trading. And I hope you all pay very close attention to what he's talking about, because Brendan, what are you up 200% during this crisis?
Yeah, a little over 300% now. It's pretty good.
Yeah, that's absolutely ridiculous. Just to put in that in perspective, most accounts are down 40 to 50%. So he's obviously doing something right. So what I've learned in the past is, obviously I was in the military. I had really good leadership in the military. One commander I had was Captain Ives, and he taught me everything I needed to know about investing. He was a very wealthy individual. He's now in the private sector working for Edward Jones as a financial advisor. So he's doing really well. And he's giving me a lot of my investment advice. So that's where I get a lot of my information, and also like online, Wall Street Journal, Morningstar, stuff like that. That's where I get a lot of information. So once he told me, how to get started, because I didn't have any knowledge about investing, he told me the first thing you need to do is start a Roth IRA. And the reason for that is because of the tax-free environment. And I'll break that down for you guys. Because obviously with investing, at the end of the year, you have to pay some taxes in a regular individual account. So it's better for you to have a free tax environment to start off. So when you're building your investment house, you want to start with the foundation. That's your Roth IRA. And the way you're going to do that is by opening a brokerage account. And you can use any of the main companies. I use Fidelity personally. Brendan, I think you do as well, right?
I use E-Trade.
E-Trade, okay, cool. So Fidelity, E-Trade, T. Rowe Price, Merrill Lynch. I don't know, do you know any others?
Yeah, I use TD Ameritrade.
Yeah, they're all really good. And nowadays, they don't even charge commission fees. Back in the day, you used to have to pay like $5 to $10 for every trade you made. They're getting rid of that because so many retail investors are starting to invest online now. So that's the first thing you want to do. Open a brokerage account with one of those companies. And after you do that, you can open two different accounts, an individual account and a retirement account, the Roth IRA. Now, I know we're really young and it doesn't really sound like something that you want to do with a retirement account. But like I said, that tax-free environment is going to be huge for you in the long term. Just think of your Roth IRA as your long-term investment portfolio, and then your individual account as like your daily trading environment, which Brendan will get into. So once you have those two accounts open, you're going to start investing gradually on a monthly basis. What I mean by that is, let's say you have $5,000 in cash right now. What you can do is you can put $2,500 into both accounts, and then every single month you can start reinvesting. Okay. When it comes to your Roth IRA, you can only max it out at $6,000 per year. So after you hit that $6,000 in your Roth, you can just start going into your investment account every single month. What I personally do is I invest in index funds. The reason for that is because index funds keep you well diversified. You're not invested in one specific stock, but you're invested in a collection of stocks. Like the S&P 500 is an example of a large index. Those are the top 500 companies in America. Or you could go with the NASDAQ 100, which is the top 100 tech companies. That's going to expose you to a really big portfolio, and you're going to grow with America. And on top of that, the cost of owning those accounts are very low. Whereas if you were to own like a mutual fund, the account fees are a little higher. So ETFs are really the future, and I recommend you guys look at those. I can give you guys a couple tickers, which are the symbols that you would type in your stock app. One being SPY, which I know that Brendan trades as well, SPY, and that's going to track the S&P 500, which, like I said, is the top 500 companies in America. So that's a good one to start with. You might want to wait a little bit for it to drop. I think Brendan's going to talk about that, but right now we're still waiting for a bigger drop in the market. But even if you were to invest, let's say at some point this week, and the market goes back down again, you just keep buying that low because you want to buy low and sell high. So your key is to get your dollar cost averaging lower. All right. So even if I bought it at 250 and it drops to 220, that's fine. I'm not going to sell at 220. I'm going to buy more at 220. That's going to bring my average down. You guys following me? Cool. All right. So that's ETFs. That's one example of an ETF SPY. Another one would be QQQ. That's the ticker for it. That's going to track the NASDAQ 100, which, like I said, is the top 100 tech companies. Moving forward, the tech companies are going to continue to be a huge profit, even in the stay-at-home economy. So you want to look at that as well. And it's a cheaper stock than the SPY. I think it's going for like $212 a share right now. So if you get two of those, you put those in your accounts, you're going to be really, really well diversified. And you're going to be looking good moving forward. I've got a quote for you guys about ETFs and about index funds. Warren Buffett, who everybody knows is like a multi-billionaire. He's the owner of Berkshire and Hathaway. And he said that he bought his first stock in 1942. And he says the best thing you can do is buy an index fund. And if you put 10,000 down in 1942 and you didn't even do anything, you didn't touch it, what do you guys think it would be worth today?
That's a few billion right there today.
Millions of dollars?
Not a few billion. Yeah.
300,000.
300,000? More than that. Brennan, what do you think?
What was the initial investment? 10,000?
10,000 in 1942.
So that's 70, 80 years. Let's see, that's 80 years. So I would say that's probably worth, I would say, my guess is 5 million.
5 million? Okay. Anybody else?
I'm gonna
2
go.
million.
That's like
I'm gonna go with about
I gotta do the
40 to
math.
50 million.
40 to 50 million? Okay. All right.
I'm going to say 1.2 million.
1.2?
Let's go. What is it?
All right. It's 51 million actually without doing anything.
Damn,
So $10,000, good job, Len, in 1942 would turn into 51 million in 2000. This was in 2018.
Wait,
so
what
yeah,
did they invest in? I'm confused.
an index fund. So the S&P 500.
Do you know, was it SPY?
I don't know if it was SPY. He just said an index fund in the S&P 500. And that's like him not doing anything. Imagine if he reinvested every single month. I mean, then you're going to be talking at least 200 plus million. So that's the idea. And that's why the rich get richer. It's not off of, income. It's off of investments and assets. And if anybody's read Rich Dad, Poor Dad, they know that that's true. That's why it's a really good book to read. It'll teach you a lot about that as well. And so once you do that, you can start looking into direct stocks, which Brendan's going to talk about, and bonds as well. Stocks are obviously publicly traded companies that allow you to purchase a percentage of their company. And then bonds are when companies give you percentages of their debt. So you're literally financing a company and then they pay you interest off of that debt. And then you can also look into something that's more safe to protect your portfolio, like gold, silver. I know people like Bitcoin. I'm not really too involved in that, but I do invest in gold just to keep, it's kind of like a hedge, which means that when the market goes down, gold goes up because it's something that, in my opinion, does have intrinsic value. It's used with technology. Robert Kiyosaki says it's God's money. So I think that's probably true, but it's not something you want, too much exposure to. I would say about 20% of your portfolio should be in gold, in my opinion. So once you have that, you have your ETFs, which are your collection of different stocks and index funds. You can start doing stocks. If you have any special stock that you're interested in, just make sure you're passionate about it. I think like if you're a huge Tesla fan, invest in Tesla. I'm personally a big Boeing guy. I believe in that company. It's the #1 exporter in the US. So I believe going forward, that's a great company to invest in, especially at the price it's at now. So yeah, then you can start doing your research on specific stocks. But that's really what I do. That's my portfolio advice. I've been able to create a 6-figure portfolio, and I don't come from wealth by any means. I've just been able to do this since I was in the military in 2014, and it adds up quickly. Whereas if I had just kept my money in a savings account and I didn't make any interest on it at all because interest rates are at 0%, I would be looking at half of what I have now. So yeah, if anyone has any questions for me, we can move forward.
Vinny, can you give us, you did this for me one time, and this may be specific for individuals, but can you give us like a portfolio breakdown as far as percentages where your money should be?
Yeah, so for me personally, obviously this is just my advice, but you should do your own research. I think at least 60% in stock, 20% in something like gold, something that has intrinsic value, and then another 20% in possibly bonds. That's a very conservative investment for the long term. When Brendan talks to you, he's going to talk to you more about riskier assets that he makes a lot of money on. That's why he's up 200% right now. But yeah, personally, I'm 60% stocks, 20% I'm in gold. And you can actually track gold with an ETF, and the ticker for it is GLD for anyone interested in that. And also you can invest in silver on the market as well. It's super cheap right now. The ticker for silver is SLV, and it's $14 a share right now. So you can buy a lot of that. Robert Kiyosaki thinks that, you know, silver is going to be worth a lot more money, so that could be a good long-term investment. But yeah, that's my advice. Anybody else?
Vinny, the 20% that you said invest in bonds, like what do you mean invest in bonds? Can you give me an example of bonds?
So an example of bond is a company's debt. So Boeing issues bonds, and you can actually purchase those bonds, and then they pay you interest on that. You can also invest in U.S. Treasury bonds, which is the U.S. government's debt. It's not really a good investment. It's more of a conservative investment. It's going to get you maybe 3%, kind of like a CD. So it's something that you're going to do that's going to guarantee you money back, you know, where stocks are more of a risk.
Got you.
I was going to ask you that. I was going to ask you the difference between a bond and a CD. I know a bond is from a company and then a CD is from a bank, right?
Yeah, exactly. A CD is going to guarantee you a certain percentage on your money. I think the tops you can get in a CD, what do you think, Brendan? Maybe 3%?
Yeah, and that's a good CD. Most CDs are a little less than that.
Yeah. Yeah, so CDs are something where you're saying, look, I don't have anywhere to put this money. It's in a savings rate account right now. It's not making any money, so I might as well put it in a CD to generate me some interest where I'll get the money back in 18 months or 12 months, depending on the maturity level of the CD. Cool. All right,
you
guys.
mentioned that, like, one more question. You mentioned that gold goes up and like when like the dollar bill goes down. Why is that?
So back in 1973, the dollar was fixed to golds, and our currency was a lot more stable. But what was happening was the federal government couldn't print as much money as they liked to because they didn't have enough gold. So Richard Nixon was the president at that point, and he decided that they were going to take the dollar off of gold and make it a fiat currency. A fiat currency being a currency that doesn't have any intrinsic value. It's only backed by what the government says it's worth. So once he did that, gold and the dollar kind of shifted, and gold has just maintained its value based on, you know, what people use it for. Obviously, they use it for jewelry. It's always going to have some value in that sense, technology, whereas the dollar is just based on what the government says it's worth.
Got it. That makes sense.
Cool. Anybody else?
Ben, I got a question.
Yo, what's up, Mike?
What's up, bro? So, if I was to buy like a stock, say for like $100, right? I buy it for $100, and then say like today or tomorrow, at some point it drops well beneath 100. It goes to like $80, right? And then I decide to buy another one of those stocks for $80. What happens to the first one that I bought for 100? It just evens out, like it just meets in the middle.
Yeah. So your dollar cost averaging would be 90.
Right. So essentially, I'll end up making more if it surpasses whatever it is. So basically, if I buy a stock at $100 and then it drops down to 80, the smart thing would be to, I guess, invest into more of those stocks, right?
Absolutely, 150%. That's the first thing I actually asked, you know, my financial advisor, Captain Ives, because I've always been like super conservative. Like since I was a little kid, I put my money in a piggy bank and I didn't touch it. So I was like super concerned, like, oh my God, what if I lose everything in the stock market? You know, if we have a great recession or something. So I asked him, you know, what do I do if the value of my portfolio drops tremendously? Do I just sell? And he said the first thing is to buy more. And I was like, oh shit, okay, that makes sense. Because an example of that would be my grandparents in 2008. They had a 401k, and a 401k is an employer-based retirement plan where they invest in stocks. And their stock 401k dropped like 40–50%. And my grandfather had no financial knowledge. And the first thing he did was he told my grandmother to take everything out. So if they had just kept that money in and in fact bought more, they would have been up like 100% since then. So yeah, that's the first thing you want to do is buy more if the price goes down. And obviously, like, you know, do your research as well. You know, if there's a stock that's like, for example, JCPenney right now is going under because they're just not going to be able to make it. They're going to go bankrupt. Then maybe you don't want to keep reinvesting in that company. But if it's a company that you believe in, like for me, Boeing right now, Boeing has a lot of trouble because of, you know, nobody's flying right now. So none of these huge airliners are buying planes. But I believe in the future, obviously, you know, the air industry is going to be a huge part of our economy. So I'm going to keep reinvesting in Boeing, even if it's at $100 a share when it was 400 a year and a half ago. You know what I mean?
Awesome. Thank you, man.
Cool. All right. Anybody else? Or are we good? We're good? All right, cool. So Brendan's going to talk about his daily trades. Like I said, he's been doing amazing. I really want to thank you, Brendan, for, you know, doing this for us. I think it's going to add a lot of value, and I'm looking forward to seeing what you're going to show us.
Cool. Let's do it. All right. So I'll start by sharing my screen. I'll go to the web page here. Everyone can see my screen? Yeah, we're good.
Yep.
Looks good.
Cool. Okay. What do I want to show you first? Okay. I think when it comes to specifically trading, I think you're gonna, as a entry level trader and understanding of like the stock market, one of the things that's really important to identify is trends and setups. So some of the most common ones you need to understand are flags, pennant flags, and just flag setups in general. And what a bullish flag looks like versus a bearish flag. Bullish meaning that the stock is most likely going to continue to go up. Bearish meaning that the stock is actually most likely going to go down. So here are just a couple really basic kind of cartoonish drawings, but you can see how this will actually play out when I share my, I'll share my E-Trade account for you guys in a second. But so understanding chart patterns. So I would start, like, if you're really trying to get interested in like specifically trading and even investing, you got to know when to time it and how to time it right to make sure you're not, you know, you don't want to be the guy that, if you're paying attention to my screen here, you don't want to be the guy that bought, you know, right here, or you don't want to be the guy that bought right here thinking, oh my God, you know, this is coming back up, it's going to go back up here, but not understanding this pattern, because this is actually a very negative pattern that if you were to buy right here, you know, maybe a day or two, a couple hours later, you could be way down on your investment because you didn't identify this negative trend. Same story goes over here. You know, if you're someone that gets really excited when the stock is going up and you buy right here, you know, if you're scared and you're not paying attention, you may sell at one of these little lower points, but may not be able to identify the bigger trend, which is that, hey, this is going to go up. You just had a poor entry here. So here, these are just some flags. There's also other things that you can look at. Really basic stock trading 101 is being able to identify levels of support. That basically means where prices usually tend to reverse, and then resistance, which is usually viewed like a ceiling, where the stock hits its head against the ceiling and then it bounces right back down. So if you look at just kind of this little cartoon drawing here, you can see that the price came up, hit its head right up against the ceiling here, came down, hit the floor, worked its way back up, oh, hit its head on the ceiling again, boom, back down, hit its, you know, hit itself on the floor, ceiling, and then boom, we broke through right there, and now we're into a new channel. So just understanding support and resistance is really important, especially when trading. So ideally, if you're doing the whole buy low, sell high, the idea is that you want to buy at these support levels and then sell at these resistance levels, or sell some, not all, at these resistance levels in case you break through to get to another, a whole nother level here. So this is very counterintuitive to what you may think, because when you're buying here, what just happened? Well, that price just came crashing down. That's actually the place to buy. Same story here. Price came back down. That's the place to buy. Price came back down. That's the place to buy. So Vinny was giving pretty savage advice there. Yeah, when things start to go down is usually when you want to be a buyer. And that's presuming that you're investing in really good, honest, reputable, big picture companies. Some of the things that I trade is I'll trade some really awful companies, but you can get some pretty insane volatility. So here I'll show, this is my E-Trade account here. I don't know if you guys can see this, but this is the year 2020. This is my, the purple line is my account, and then the green line is the US stock market.
Crazy.
So if you look at the beginning of the year, you know, we were kind of neck and neck. And then as the market started to drop down here, my account started to really take off, just because I have a different strategy for these sort of times. So yeah, if you look at my account to the year to date, I'm up 237%. The stock market S&P 500 is down 12%. So had some pretty good performance so far this year. So let me jump into my E-Trade account here, and I'll show you guys some setups and things that you can pay attention to. And I'm not going to show you any shit companies. I'll show you all good stuff. So this is a really popular coronavirus company right now, mRNA, which is a company that potentially will have the cure or a vaccine for the coronavirus. There's a really big story behind this company, which is why you're looking at their stock, which, you know, in the big, I gotta probably even teach you guys all this stuff too. So let me back out. Let me go over here. What am I sharing right now? Can you guys still see my,
We can
Twitter.
see Twitter.
Twitter? Okay. Can you see stock charts?
Yeah.
All right, cool. So let me explain what you're even looking at. So each one of these little bars is what's called a candlestick, which represents, in this case, I have the period shifted to weekly, which represents 1 week of volatility with the overall SPY, which is the top 500 companies in America. So you can see we were at the end of 2009 or the beginning of 2019, every week, for the most part, this was in a really nice, like, uptrend, which is why forever index funds are a great place to put your money, because, you know, in the beginning of 2019, you would have had it at $250 per share for the index fund, and that would have gone up to 330 by the end of 2020. So you're talking about buying at 250 and having the opportunity to sell up here at 330. But then obviously you guys kind of have an idea of what happened with the stock market. And we went from 330, and 3 weeks later we were at 220. So one of the rules, or one of the things you hear talked about a lot in the stock market, is you take the stairs up. So as you can see, we go up, down, up, down, up, down, up, down, up, down, up, down, taking the stairs on the way up. And then on the way down is usually the elevator, where you just drop floors at a time, as we went crashing down to 220. So that was at the low point at the end of March. We've now gone from 220 up to 282. But one of the reasons I'm a little still negative on the market is, let me go back now. I'm going to go back over to E-Trade. Let me show you SPY here. See if I got that pulled up. Yep. All right. So let me go to the daily setup, last 120 days. Okay. So I'm going to draw you guys a picture.
I don't think we can see it.
You can't see my E-Trade?
No.
No? Okay, hold
No,
on.
not yet.
New share. Bang. How about now?
Yeah, we're good.
Yeah.
All right. So here, this is SPY, SPY. Here's the daily time frame. So that means each one of these little tiny candlesticks represents 1 day of buying and selling. And then over here, obviously, you can see the price. And so one of the reasons why I'm still pretty negative on the overall stock market is, if you go back to the little pictures that I showed you, this is a negative trend. So this is a flagpole. And then, so imagine that being a flagpole, and then the flag is opposite, which looks like this. Okay, so you guys see how we have we have this general move down, and then we have a little bit of a flag that way. So if I were to flip this upside down, think of a phone or a flagpole and then a flag. You guys can see that setup right there. And I'm gonna go back over here to these flags and pennants. Can you guys see the flags and pennants again?
Mhm.
Yeah.
You guys got me? You
Yeah.
can still see my flag? Okay. So if you look, one of the setups of a negative trend is a drop, and then this little move up, followed by another drop. Okay, so this is stock trading 101. This is why you want to know what your patterns look like, because we had a big drop, and then we had this little upward sideways action before that's actually setting up for another drop. And if I flick back over here to the US stock market, the SPY, that's exactly what we're looking at here. We got a move down, and then we have a little bit of a trend channel up, which should be followed by a move back down here, which is why I think we're going to retest. So for me, stock trading is all about buy low, sell high. So buying down in here would have been a good idea. And then I would actually be, if I was a buyer here, I would be a seller somewhere in here because I need to see confirmation of a move through this red line. And if I can't get a move through this red line, which is should be the 100 simple average. Yeah. Sorry, this is probably way over your guys' head, but I'm just showing you kind of how I think. We should be followed by a move back down unless we can get through this line right here, which is at $300, which I don't think we're going to do. So I'm still overall pretty negative on the overall markets because I think we're going to see a move back down. So let's look at a couple other just specific companies here.
Brandon.
Yeah.
So like, you speaking my language. So I just want to ask you, like, so at any given time, you never scalp the market. So just before like you catch like the big moves.
Yeah, for sure. That's how I make the majority of my money. But what's something that I played recently that I can show you? I'll scalp all day long. All right, here's Uber. Let's take a look at Uber. So Uber, this is when Uber first started trading about a year ago in May. Their stock kind of moved itself up, and then it had this like big sell-off. And then Uber actually started to rally, and then the coronavirus hit, and then their stock just like totally tanked as people stopped taking Ubers and stuff like that. But this actually recovered and created another little flag here. And actually, we have something quite interesting. So understanding support and resistance. Let me show you. So if you can see this right here, the stock price really struggled right around this area right here, which was right around $28.77. I could really probably call it about $29, to be quite honest with you. So this was a level of resistance. See how it hit its head, fell back down, hit its head, fell back down, hit its head, fell back down. And then we actually broke through this level, which is really interesting. On Friday, they broke through $29 a share. So this could be a short-term thing that if you wanted to buy into, just really short-term, if you could identify this breakthrough at $29, you could have been a buyer at 29, and then I would be looking, Lamarck, if I was scalping this, to sell right at this yellow line, which is at 31 bucks.
Yeah.
So you could buy at 29, sell at 31, because the overall setup is still pretty negative.
It's still really negative.
Yeah, but because we broke through this huge level of resistance right here, I mean, you're talking about 1, 2, 3, 4, 5, 6, 7, 8, 9 times it tried to break through $29 and it couldn't do it. So this is guaranteed going to move up on Monday, for sure. And then I would be targeting a sell point probably right around $31, and then I would hold on to a little bit more and maybe sell right around this area at $34. I'd for sure be all out at 34 though. Just based on kind of this setup. So yeah, I'd for sure scalp Lamarck, to answer your question. So
yeah, I mean, I only ask because like I'm a scalper myself. Before I catch like the big moves. That's why I asked.
Yeah. So I know that was pretty advanced. Does anyone want to hit me with some basic questions that I can kind of walk you through some more basic stuff?
I got a question, Brennan.
Yeah. What's up, Mike?
like in that example you just showed with Uber,
Yeah.
You'd buy at 29, you'd sell at 31.
Yep.
How much are you buying at 29? Like how much for somebody that's just starting out, I guess, like how much would you, like if you were just starting, what would your game plan be on going in on 29? How many stocks are you buying? And then, what's your whole game plan there?
Yeah, really, really good question. So if I could go back and give myself advice. So one of the reasons, let me rewind. So one of the reasons why my account is up 300% is because I've blown up, what's called blowing up. I've blown up 2 accounts before, which means that I started with 10 grand in each of them and I blew them up, meaning that 10 grand is like, it's gone. I lost it. So part of the reason why I'm doing so well is because I've done really bad. Most people that get into trading never get past a year because it's incredibly hard. I don't want to say difficult. It's like learning another language that in order to be fully competent at, you just won't master a language in a year. You're gonna need to practice it constantly. You're gonna screw it up a lot, right? If you're learning Spanish, you never spoke Spanish, it's gonna take you a while to pick up Spanish. Most people get discouraged and don't use it consistently enough to master Spanish. The same thing with trading. So if I could give any advice, especially with somebody who's new, I would not be getting into this to make money. I would be getting into this to become accurate. To be a really good trader, you need to be right about 65 to 70% of the time. If you're right 65 to 70% of the time, you'll have really big wins. So for me, I lose on trades all the time. It's just I get out of them once I'm losing, and you got to really put your ego aside. Like, look, I fucking lost. I made the wrong move here. You sell and you wait for another setup. So with going back to your question with Uber, right? Like if I'm just learning this, I'm buying 1 share at 29 and I'm selling at 31. You'll literally make $2, okay? Because you're buying at 29, selling at 31. But I'm not worried about the $2. What I'm worried about is I'm worried about the accuracy and identifying the setups and being right. Because then once you're right consistently, now you have permission to use big money. I wish I knew that when I was younger, because I want to make money. I want to make money. I want to make money. But that's the wrong mentality. You want to focus on your accuracy and identifying a lot of this shit and becoming to the time. And then you can back it up with some real money to really start scaling in and making some big boy cash. So this account that I'm using, so let me go over here and I'll show you kind of how you don't really need a lot of money. So let me share again.
And also, I don't mean to interrupt, but I also,
Sure.
is it, like I heard that it's like, I don't know if it's true or not, which is why I'm asking you, but based off like when you buy a stock and then you sell, if you don't hold on to it for a year, you get, is it like a 35% like rate that they tax you on or take away from whatever your profits are?
Yeah, that would be short-term capital gains. So any money that you make where you don't hold something for more than a year, you will pay a capital gains tax on it. Very similarly, short-term capital gains, which is very similar to you getting a paycheck, except I don't know what the tax rate is. Do you know if it's 35%, Vinny? I don't know if it's that high.
No, I think it's 15. Isn't it 15?
15? I think that's for long-term capital gains. Short-term capital gains, which is less than a year, Mike, is a little bit more. I'm not sure the exact percentage, but it's in the 20s to 30s for sure. For sure.
Okay. And even if you were to take that out of Uber and then reinvest it into another stock, you're still going to get hit 35%, right? Because you took it out technically from the stock you first invested in.
Yeah. So at the end of the year, what your overall performance is will get taxed. So like, let's say so what's cool is that the 2 times I blew up $10,000 accounts, I'm actually able to write that off because I lost $10,000 in the stock market. I actually was able to write that off and get some money back at the end of the year for losing money. So if you lose money in the market, you actually can use it as a tax write-off. But no, you don't get taxed the 35% on each trade. I keep 100% of it if I'm right. It's just at the end of the year, when I have to file taxes is when I'm going to pay that short-term capital gains. Oh, there you go.
Yeah, it's a progressive tax rate, just like the federal tax rate.
Got it. So it's just like income that you would make with your job. Same story. So the more you make, the more they take. Is that how it scaled up? I didn't look it up. Did you look it up?
Yeah. So from 10, 12, 22, so on and so forth.
Got it. Okay, cool. So let me show you, what was I going to show you? I was going to show you guys something on E-Trade here. Let me go back to sharing my screen. Yeah, so you can do quite well with this. So this account that I'm using, this is my trading account. So if you look, this is my current account. I got 127,000 in this trading account. I actually started this account with $15,000. So I turned the 15,000 into 127,000. So you really don't need a lot of money to make a lot of money once you focus on being more accurate. So all I've done is I've just improved my accuracy with what I'm doing, and that's allowing a lot of wins to stack up consistently, which is how you're able to turn 15,000 into 127,000. Vinny's right though. Some of the stuff that I do is a little bit more risky, but one of the things you're going to want to learn, and this is how you protect yourself, is using limit orders, stopping, what are called stops. So if a price hits a certain level that you don't want it, or you do or don't want, it'll automatically take you out of the market, assuming that you put this order in. So like, for instance, like let's say I could put in Uber, right? And let's say I want to buy 100 shares of Uber at, let's say $29. Let's say I bought that breakout at $29 right here. So I'm buying 100 shares at $29. That trade is going to cost me $2,955. So going back over here to Uber, so let's say right when this price broke through $29, boom, I'm in. I have $100 shares at $29. Okay. So once I own these shares, one of the keys to guaranteeing yourself becoming a winner is that as my trade starts to move up above $29, I would go back over here, okay, and then I'm going to put in a sell order at, let's say, $28.80. So I want to sell this. I'm going to sell only if my price hits $28.80, okay? Because I've identified that here's a resistance level. It's got through 29. I'm like, oh, hell yeah, now this is going to go to $31. But just in case I'm wrong, and let's say this breaks out but then immediately takes a huge jump, I have a sell order in at $28.80, which basically means that I'm only risking 20 cents on the trade. Remember, because I bought at 29 and I'm going to sell at 28.80. So if I'm wrong, right, and instead of this continuing to go up like I think it is, and let's say it turns over and comes back down, I'm only going to lose 20 cents on that trade from $29 to $28.80. So understanding how to use stops are really important. I did not know anything about stops when I first got into trading. And what would happen is when I was wrong, it would go down to $28.80, $28.50, $28. And I'm like, oh, it'll turn around. 27, 26, 25, 24, 23, and then all of a sudden, shit, now you were wrong and you take a big loss. So having a plan once you get into a trade is really important, knowing that, hey, I'm going to buy at this price, and then I'm going to set a sell at a certain limit. That way, just in case you're wrong, you're not taking a gigantic loss. You're only taking what would be like what I call a paper cut loss. You're only losing a couple bucks on the trade, and if you're wrong, no problem. Now, if you're right, then boom, that $100 shares goes to 30, 31, 32. And if I buy at 29 and sell at 32, well, I just made $3 times 100 shares. I just made 300 bucks, boom. And I identified that trade correctly. So my risk reward setup there was really was really good. I had low risk, high reward on that setup. Does that make sense? I don't know if that's, I'm talking at a
awesome.
Yeah, that makes sense.
high level.
Yeah, that's pretty cool. I have a question. Do you have any specific rate when you choose to sell? Like, do you have any percent? Is it under 10%, under 20% if you're going to lose? Or if you're losing?
So if I'm, what I'm willing to lose, is that what you're asking? Like,
yeah.
20% is a lot, because if I had $1,000 on 20% loss is losing $200 and only keeping $800. My stop losses are usually 1 or 2% max. Like when I'm right, like I want to be right and the price just keeps on going, baby. But when I'm wrong, I want to be wrong barely and then just take the little baby loss. Because if I invested $1,000, right, Uzi, and I take a 1% loss, do you know how much that is?
A 1% loss?
Yep, on $1,000. So if I invested $1,000 into something and I have a 1% loss, how much did I lose? $10. Yep, and I'm left with $990.
Wow.
Make sense?
Wouldn't
Yeah.
you say that you're able to identify whether you're right or wrong based off of your experience? So would you say in the past were you still taking those that 1%, 1 to 2% loss, or were you kind of taking more of a risk because you were learning?
I was taking gigantic. I was doing dumb stuff. Your entry price is important, and your selling price is important. So remember, when the stock is going up, when things are going up, and you're like, holy shit, this is taking off. And let's say you don't own the company, you're just sitting on the sidelines, and you see the price just like taking off. Instinctually, in your heart and in your like human body, you're gonna be like, holy fuck, you're gonna have FOMO, fear of missing out. And you're going to want to buy as it's going up. You're like, holy shit, this is going up. I got to buy it. The problem is that just as excited as you are to buy it, the guy that bought it a day or two ago is so pumped to sell it because he bought it at a way lesser price, and the price is taking off. He's hammering the sell button while you're hammering the buy button. And if 9 times out of 10, you're going to miss it. You're going to buy too high, and then all these guys start to sell. And as they sell and they flood the market with shares, that pushes the price back down. And now you're in the trade incorrectly. You bought high, and now you're waiting for it to come back up, and you're praying. So what you want to do is you want to buy as the price is coming down, like Vinny was talking about, and you want to look for levels of support. So let me see if I can find a good support chart for
Tesla.
you.
Show them Tesla, what you did with that, yeah.
Yeah, okay, so let me pull up Tesla. I know I'm not sharing my screen, but let me make sure Tesla is such a ridiculous chart, though. It's a tough one to teach on because it's just a total joke.
It's crazy.
It's a crazy chart, but okay, yeah, Tesla will work. I'll show you guys Tesla. So let's go. So remember, support is where the price hits. Okay, so is where it hits a floor, and then a resistance is where it hits its head on a ceiling. So I'm going to show you, this is Tesla. So here's Tesla. This is in the last year. So Tesla had this ridiculous move. Maybe I should show you 2 years of price history with Tesla. So Tesla traded forever between like $270 and on the high side, like 300. Okay, so you guys see this? I'm going to point out a couple areas of resistance. See this right here, and then right here. See how the price came up? I'm going to put a line there so you guys can see that. You guys see how the price, this is in 2018, hit its head, came back down, boom, hit its head, came back down, boom, hit its head, and then it didn't like it, so it kept going down, 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 down. Do you guys see that?
Mm-hmm.
Yeah.
You guys got me? Okay. Yeah. So then this was a major point of resistance. 1, 2, 3 times it tried to break this area, which I would call, it looks like $380. And then Tesla went on this crazy rally because look what happened. So in the beginning of, let's see, what are we at? 2019. So in December, Tesla's price broke that 380 level. See how it hit its head on this day, but then the next day it broke through that 380 level. Well, that was a really big level for it to break because it tried once, twice, 3 times, a 4th time right here, and then boom, the next day it broke through. And look at this shit. It took off from $380 and went all the way up almost to 1,000. You could have 3x'd your money on Tesla if you just were able to identify that breakout right there. All you had to do was just buy and not do shit.
Crazy.
And you would have 3 times your money on Tesla. Okay, but then what's
now,
that?
Brandon, now question for you, right? Now, okay, so looking at like the support and resistance level, right, that they try to break through, right? So if you was on that chart at that given moment, right, you would have bought it once it broke that level, right?
Broke through the level because I needed it to confirm that it was gonna motherfuck those 380s. Those 380s were hard. It didn't like 380, 380, 380, 380, and then boom, we're through 380. So what I would have been is, if you're playing with huge money, I would have been a buyer at 390, and I'm risking 380. So I would have been a buyer at 390. I wasn't.
You set a stop loss at 380?
My stop loss in this instance would be at 380, yeah. And then I would have been at 390. And look, the price didn't even test. It didn't even come back down to test it. If you were a buyer at 390, you were in the money all day long. You were in the money. Didn't even, you would have been winning every single minute, every single day until the market had the huge sell-off. So Tesla dropped like crazy because the overall market dropped. Now, not surprisingly, Tesla went from $950 and then look, whoa, baby, it fell fast. And if you had to guess where it was going to bounce, look at that, right around $380. It came down and it actually went down to $340. So anything under that 380 level would have been a good buy. And then boom, we bounced right back through 380. That was a really key area. See, it just dipped and then was like, oh, nope, I want to be back above 380. Because any level of resistance, once you break through the resistance, now this level becomes an area of support. This is a really key level. And this is where if you had an opportunity to buy again after this breakout was a really awesome buy. So you could have bought again up here at 380. And today we're at $725. You would have doubled your money by just being able to identify, oh my gosh, we're at a really key level here. And this just happened. I mean, this was in March. So if you identified that 380 level and you were a buyer again right here, you would have doubled your money. Even with a huge company like Tesla, a month later, you would have doubled your money.
Brennan,
So
do you ever set up take profits?
Of course, yeah. So anytime I'm in the green, like especially Tesla, like Tesla's move was ridiculous. You're talking about a 200% gain on Tesla, 300% gain that you could have had by buying and selling within a month. Anytime you have those huge gains, that price action is not sustainable because the stock needs to do what's called a consolidation. It needs to, the buyers and sellers need to average out. You want to see sideways action because just as fast as something goes up is just as fast as it will go down. So if you invest in something that takes a very long time for it to move up, generally it's going to take a little while for it to move back down. But if you buy something that shoots straight up, it's most likely going to shoot straight back down, which is exactly what we saw with Tesla here. Because let me go back. I'll show you that again. I mean, this move was ridiculous. I mean, within a month, it shot way up, and then not surprisingly, within a month, it shot right back down. But then, you know, like I said, if you were smart and you were able to buy here, you would have had a good idea that this was going to bounce again, and that's sure as hell what it did. So yeah, that's just understanding support levels and resistance levels, and then flag setups are really important so you know when to buy and when to sell. Because, I mean, think about this. Tesla was making daily headlines when it was hitting almost $1,000 a share. And so, you know, for guys like, you know, you guys that, you know, you're not really in the market maybe that much, and you flip on the TV and you see them, oh my gosh, Tesla's almost $1,000 a share. Holy shit, I should buy, right? And a lot of people did, thinking, oh my gosh, you know, you better get it before it gets to 1,000 because it's going to go to, you know, it's going to go to 3,000 or whatever. A lot of people bought up in here, which is totally the wrong thing to do because a month later they would have lost 70% of their investment. That's why most people fail at this, is because when everyone's excited, that's the time to sell. That's not the time to be buying when people are excited. You've got to do the opposite. And I can pull up Bitcoin and show you that too. No one knew what the fuck Bitcoin was until it started running up thousands of percentage points. And then, you know, you get in an Uber, you go to your haircut guy, and all of a sudden they're all talking about Bitcoin. When people start to get really excited about something is when you need to sell it. Because that means that there are literally tons of smarter people that bought in way before you, and they're pumped to sell. And so if you don't do it the right way, you're going to buy high and sell low, and that's how people lose money big picture in the stock market. So that's why when I go back to the overall our U.S. stock market right now, one of the reasons I'm just not that big of a fan right now of buying is because I don't trust the setup. The setup is showing, let me see if I can flip buy again. We're right here, right? We're at 380, which when you compare it to 220, or at 280, sorry, when we were at 220, you know, that does look good. But when you zoom this out and you look at the overall picture, this is a bearish flag setup that once we break through this little channel here, I think we're going to come, way down. And let me show you the last, here's the last 20 years of the US stock market. So here's that big recession in 2008. So let me show you another, this even works right here. So look, this was a key area for the chart. So if you look right here, this is in the year 2000. We hit 160. We came back down. We tried to get through 160 once, twice, 3 times on 3 separate months. Because remember, look here, I'm looking at months. So each one of these little candlesticks is 1 month. And then right up here was 2007. We thought, oh my God, the stock market, look at this beautiful trend. It's going to keep going up. And then all of a sudden we went from 160 all the way down to 60. So if you were a buyer in 2007 at 160, you would have lost $100 a share and gone all the way down to 60 here in 2009. So from 2008 to 2009, that was really a big drop for our economy. And then since 2009, we've been on this really nice upward trend, which most of you in your teens, you've never really seen a huge economic drop. We've had these ups, little down, up, little down, up, down, up, down. But generally, we've been going up. And then, you know, up until this year, we were going way up. And then all of a sudden, bam, we've really, really come back down. And these are moving averages. That's a whole nother lesson. We hit right off here. I think that's my 200 moving average. Let me look at that. That's my 100 moving average. I bet that 200 is even lower. Yeah. So this is, for those of you that are like, hey, Brian, what do you think the stock market's going to do? I personally think we're going to come back and test this level of 170, even maybe 160. 160 was a key level down here. Once, twice, 3 times, 4 times, 5 times. We broke through this key level right here and then went on this beautiful run. I would not be surprised to see us come back down and test 170 or even 160. This is where I would invest every dollar. If we get down to here, I'll invest every dollar I have in the US stock market at this level. And that's the area I'm targeting. So I think we have a potential to go from 280, which is where we are right now, to 170. I still think we have potentially a $100 per share drop in the market. We'll see. A lot of people are saying that and the price is doing something else, but that's where I'm going to be a huge, huge buyer at that level.
Why at that level?
Because that is so this chart that I just showed you, Isaiah, is I'll go back to it. This chart level here, this is the last 20 years of the stock market. So we're looking at a lot of data, and the data tells me that this level of 160 is a really key level. And then this is what's called a moving average. We already hit the 100-day moving average. This is the 200 moving average. 170 and 160, you're pretty safe buying in here. I mean, that's like almost no risk at all in those areas because you're looking at 20 years of history. And the price action over the last 20 years says that that would be a really, really key level and one that many buyers would come in and buy at. And then what would happen is, remember, as quickly as it drops is as quickly as it bounces. So I think that if we get a nice little quick drop, even if it's for a week, we come down here and test this price level, I'll be a huge buyer because I think we'll snap right back a couple weeks later back into this 260 area. And then we'll be on our way back up to 400 or over 400 once the economy, the coronavirus and everything recovers, which it will do. That's kind of my thought. Yeah.
What do you think it'll take though for the market to drop to 160? Because right now the government's injecting trillions of dollars into the economy. You know, it's propping it up through the quantitative easing. The Federal Reserve is just printing money, right?
Yeah.
They're purchasing bonds from the federal government to keep it going. So that's the reason why we've had a bit of a recovery, right?
Yeah.
Since it dropped so much about a month ago.
Yeah.
So what do you think it's going to take? What event? Do you think maybe the quarantine lasting longer than it's currently expected to? I know current reports say that we should be back by June. So there's going to be something that happens for it to drop that much, right?
Yeah. The event, weirdly, Vinny, that I think is going to be what tanks the market is when we get back online. I think when they say, hey, everything's back, you know, we're good to go, I think is when we're going to see a huge drop. I think it's kind of you ever heard the buy the rumor, sell the news?
Yeah.
You ever heard that? That's a really common one, especially with, you know, companies. You'll see that if something rumored is big, that's going to happen with a company, their stock price keeps going up, 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 and then the actual news breaks and you were right. That's when everybody sells. So it's called buy the rumor, sell the news. I actually think that's what we're witnessing here. I think the rumor is that the injection of cash, the quantitative easing, all this is a really good thing. It's not a rumor because it's reality. It's a good thing, which is moving the markets up. But I think once we get back online, I think we're going to see a huge drop because me personally, I think the damage from this is way bigger than what people are thinking. We're talking about the biggest unemployment rates we've seen since the Great Depression. We're talking about tons of companies that, yes, they have some cash, but we're talking about damages that I don't think many companies are going to be able to recover from, which is going to cause, I think, a huge sell-off as it becomes it's going to turn into show me. Right now it's like, okay, this sounds good, but then it's going to turn into, okay, let's see it. Let's see it in the numbers. Let's see it with the reports that this is getting better. And I don't think we're going to see it. And I think that's what's going to start to drop, believe it or not. And we know it's bad because we're pumping this much money into the market. That's how you know it's bad. When the government's willing to pump up this much money, we've never done something like this, to pump this much money into the market. I mean, that's how you know they're taking it seriously and they know it's really bad. So unfortunately, I think it's going to be a little bit too little too late. And that's why I think we're going to retest the lows. But that's just my theory. I could be dead wrong and this could bounce right back up and fuck, I missed a great opportunity. But yeah, that's how I'm looking at it.
So absolutely, if you go back to the Great Depression, that's why it lasted so long. It wasn't because of the stock market speculation that started it. It's because the banks ran out of credit. And, the Federal Reserve didn't step up. They didn't act. They didn't start printing a lot of money. So if you go back to 2008, the Fed stepped in. They started a lot of this QE. That's what we're doing now at historic levels that we've never seen before. Now there's potential that the Fed could lower interest rates to below zero. That's another effect that they want to do to try to stimulate the economy and just keep people buying money and just investing into the economy. So what do you think the government could do? Do you think they should continue to step in this aspect, or do you think they should, lay off for now?
That's a good question. I know why they're doing it, because they're trying to keep the markets pumped up, and it makes sense. Like, I get it. They're not trying to cause panic, and because we're in a very consumeristic, economy where everything relies on buying and selling. And if the death nail is when people get scared and they stop spending, that's when we're in a really, really big problem. So I understand why they're doing it. I personally think that I think they should stop. I think in a real free market, like, I don't want to see bailouts. Like, I want some companies that deserve to go under, because a lot of them were doing stupid shit, stock buybacks and bonuses, and they were really, really, just really irresponsible with the money that they had. And I think they deserve to be punished and not be bailed out. A lot of the big companies. And I think what that would do is, I think it would be painful short term, but I think long term would create a much stronger economy, and a lot better financially run companies would come out of that. Kind of like the, kill off the weak and let the strong survive is kind of my personal opinion. But, no one wants to see, these gigantic companies go under, and I know why. I get it. Like, I do get it. So, I understand what they're doing, but me personally, I'd like to see them not do it. But I'm also in a totally different position financially than a lot of other people. I think for the masses, it's probably the right move. But selfishly, I'd like to see them let some of these big guys go under, because they deserve to, in my opinion.
Yeah, I agree with you.
A Brandon question. So don't you think like unemployment will cause like an effect in the markets as well? Because like the wages for each company is going to get inflated, right? As like the company makes less profit. So don't you think that will affect like their worth of the stock in the market?
Yeah, for sure. Which is why I think when we get back to work, everyone thinks, oh, wow, everything's going to be great. I say, hell no. I think no way. Because I think even if companies had, let's say big companies had 5,000 employees, and let's say they laid off 3,000, bringing 1,000 back. I think a lot of these companies are going to keep thousands of people off the books, because this was a huge scare for a lot of companies. And I think a lot of companies realized, like, oh shit, we were over leveraged and we were spending in areas we didn't need to be spending in. And I think it's going to cause a lot of big companies to get a lot more conservative. Short term, maybe with the SBA loan, just the way it's written out, a lot of employees will come back. But I think it's going to be a totally different way that a lot of big businesses are going to look at how they run their companies. And I think the unemployment rate is here to stay for a while. And that's not good. You need people working and making money. And that's not good for the overall economy, which is why I still think we're going to retest some lows, personally. But we'll see. We'll see.
So if you're one of these guys right now that has not invested before, they're interested in getting started, where do you start? Are there specific stocks you're going into, or are you waiting for the market to continue to drop?
I would do, so if I was, this is seriously what I would do. I would go and look at a bunch of chart patterns and study different like setups and making sure that you can identify when's a good time to buy, when's a good time to sell. Because the novice thing to do is like, oh, I have a truck and it's a Ford. I'm going to buy a Ford. And like, that's cool. Like, there's nothing wrong with that. But you want to make sure that when you buy Ford, if you want to buy, you want to make sure you're buying at a good time. So part of understanding that is understanding support levels, resistance levels, flag setups, things like that, patterns, inverted head and shoulders patterns. There's a bunch of them. And all you got to do is just a quick Google search to identify all these patterns and just study them. When I was new, I made flashcards. Me and my buddy would do flashcards with the setups, and we'd flash the setups at each other and see if we could get them right or wrong so that we could get really good at identifying those setups. Really easy thing to do. It was a lot of fun until we mastered what those setups look like. And then what I would do once I have that down is I would write down maybe 15 or 20 companies that I'm actually personally interested in. Don't worry about all the other stuff that's out there. Just 20 companies that really do pique your interest that you think would be a cool company to invest in. Identify those setups, and then in a notebook, write down price levels that you think that you would be a buyer in, and then just track every day the market and wait for that price to hit. And then in a notebook, write down how many you would buy, at what price, and how much that would cost you. And then how long you're planning on holding it. And then check back in a month or two to see where you are. And I would do it all on a piece of paper and in a notebook. I wouldn't use $1 of anything that I own when I'm learning this, because the chances are you're going to be wrong and you're going to be wrong a lot. And you want to be wrong when it's not costing you tons and tons of money. You want to be wrong when it's just on paper and a pen. And if you want to use real money, because if you're like, oh, I need real money for this to make a difference to me, then okay, fine. Use real money, but I would only use a couple $100. You know,
would you say to use a paper trading account?
Yeah, exactly. You could use a paper trading account, a couple $100, things like that. But I would not be like, okay, cool. You know, I worked my entire life to save $10,000 or $15,000. Now I'm going to go put it in the stock market. Because if you do it wrong, like I did when I was younger, you'll turn that $15,000 and you'll miraculously turn it into $400. And you're going to be like, and then what's really sad is then you'll tell yourself shit like this. If I just did the opposite of everything that I just did, I would have made a ton of money. Because you literally were wrong at every step of the game. Because the stock market is designed to fucks with you mentally. It's buy low, sell high, but like I said, you're gonna want to buy when shit's going up, and you're gonna want to sell when shit's going down, because that's a normal thing to think. When you got to do the opposite. When everyone's running for the exits is when you need to be running to buy, and when people are running to or wanting to sell or wanting to buy is when you need to be selling like a motherfucker. So it works very counterintuitive to how you would think it should go.
Brennan, I have a quick question. By the way, this has been very educational. Thanks for having me.
Sure, man.
What advice would you have for somebody like myself that's been working for a company for 15 years, has a substantial amount of money in a 401k? I took like a 25% loss, and then it went back up to 12.5%. Now, I can't take my money out,
Right.
you know, with what's about to happen. Any small advice you could give somebody like myself?
Yeah, so I mean, if you're in if it's just a 401k, I mean, I think overall, just letting it sit, you're going to be fine. I think the only way you lose is if you cash out that 401k. I think in the big picture of things, I think in the next 3 to 5 years, we're going to be testing all-time highs again with the markets. We're not really in a position where, you know, I'd be messing too much around with that. But if I had some extra cash, like on the side, and I had another account that, you know, I was interested in using, I would open up another account with maybe some money that I have saved up. And now's in the big picture of things, now's a really good time to buy and invest into the overall market. I just personally think that we're going to retest a lot of the lows with our market. I just think the markets in general are going to retest the lows. So I'm personally waiting to invest a lot of my money that I have saved personally for the markets to hit newer lows. But I think in the big picture of things, if you just had money and you just wanted to throw money in and wait 5 or 10 years, I think you have no problem buying right now. I think you're fine. But just, I'm trying to time it right. And, you know, that's always a tricky thing because the markets are very unpredictable, as we all know. I don't think anyone saw this huge crash coming, but I just think just from how I'm looking at technical analysis, things that I know about the markets, I just think overall in the big picture of things, I think we're going to retest some of these lows just for the reasons that I shared already. And then just based on the daily setup here, I'm showing my screen again, the last year.
Brennan, when you get a chance, can you put your screen on the flag and pennants for a second? I want to screenshot it really quick.
Yep. This?
The flag setup.
Oh, flag setup. Okay, got you.
Thank you.
This guy, right?
Yep.
Just drop the link in the chat, Brennan.
Yeah, I mean, all you guys got to do is just search bull flag, bear flag, and just search stock patterns. You know, I just searched for this one. I just searched support and resistance, and then just go to images. Support and resistance stock charts.
Brandon, I got a question.
Yeah, what's up, bud?
So when you're doing your trades and stuff, are you mainly selling? You're buying, and then once it breaks through that wall, are you selling, or is there any specific stocks that you're, even though they're breaking through and they might come back down, you're holding on to because for whatever reason you pick up something that tells you it's going to go even higher than what it did when it finally broke through that wall?
Yeah, so from just a trading perspective, if I'm right, I do what I call scaling out of a trade. So for instance, if I bought like going back to that Uber example, right? I bought 100 shares of Uber at $29. I would sell little chunks and I would scale out of my position. So once it goes to 30, I'm going to sell 15 shares. When it goes to 31, I'm going to sell another 15. When it goes to 32, I'm going to sell another 15. And that way, if I'm right, I'm still making money as this bad boy's going up. But then let's say it hits 34 and all of a sudden it goes back down to 33, 32, 31. Well, I've slowly sold all the way up to 34, that when it comes back down and goes to 33, I'll just sell the rest at 33. And that's how I guarantee my winners. I scale out of my positions. Remember, these are, when we say trades, these are things that I'm in and out of within a day, a couple days, a week. If there's something that I feel really strongly about, because I've done a lot of homework on a particular company, and I'm investing. So the difference now with an investment is it's something that I'm buying and I'm going to hold on to for a long time. So there was, one of my longer term investments is in this little tiny biotech company called PAVM. And I bought PAVM at $1, believe it or not. I own this company at $1. But a lot of the big boys that I respect, that I follow on Twitter, and I follow a lot of like scientists and people that are really, really well educated. This company has like literally 8 products lined up that need to get FDA approval that are going to go into the medical field, and they're going to enter literally a multi-billion-dollar industry. This is a little tiny company, and they got one of their products approved by the FDA, and they have a few more coming. And so I'll show you what their stock did for me this year. I was a buyer here. Look at this. I was a buyer here at $1. I bought this little guy right when it broke out of this little trend. See this negative trend? And then it broke out. I bought it right here at about $1, right here at $1. And then we went from $1 all the way up to $3.50, back down to $1.30. And then today we're at $2.50. So I'm up over 100% on that. And that's an investment. That's not a trade. I think that little company by the end of the year is going to be over $10. So I'm going for 1,000% winner on that one. My goal is to buy at $1 and sell at 10. It's going to take all year for that to happen, but where else are you going to get 1,000% return in a year on an investment, right? But same story. I bought at $1, and my risk was only 97 cents. I had a 3% risk on that. So if I was wrong, I was going to sell, and it was going to be a small little loss for me. But I'm right, and by being right, I'm up over almost 150% on just that one investment alone. Because if you look, I bought at the break of $1, which was right here, $1. It broke right through $1. We've never come back down to this level since that day I bought it. I bought it right here, right at $1. Never gone back down. I was right the whole way through. So by being able to identify trends and doing some homework on some companies that are legit, you can turn you can turn a trade into more of an investment as long as you've done your homework. But most of the time, I don't do my homework on a company. I just buy and sell, and I play the up and down short-term moves for a day or a week, and I'm in and out of my trades. I get my little percentages, 5 to 10%, 15%. If I'm really right, more than that, and then I move on and find the next one. But it is a little bit more time-consuming, if I'm being quite honest, because you got to spend time finding those setups. It's a lot easier just to buy into something that you fundamentally understand and believe, and just let your money sit. Nothing wrong with that either.
So, for example, you told me that if SPY were to hit 212, you would buy long-term on that, right?
Yeah, so SPY, I would not put every dollar I have into SPY right away, but I would do it at these levels. So I would be a buyer, Vinny, of SPY. I'm a buyer at the lows right here. I'm a buyer at 217. I'm not buying everything. I'd buy maybe 15% of my money. I'd buy here. If we get back down to 200, that's a key level just because psychologically 200 is a level they don't want to break. I'd buy another 15 or 20% here, and then I would save the rest of all the money I have for any sort of huge downward move towards this level again of the 160, 170. I mean, seriously, if it went down to 160 or 170, I'd put every single dollar I have into it.
Which is more unlikely, obviously, but 212 or anything in the 200s is a really good buy.
Right, exactly. And so let's say it hits that 212 or that $200 level, and I'm holding my cash waiting for it to drop again. And then I start to see, oh shit, all right, it's starting to reverse. It looks like 200 was the bottom. Then I'm going to scale into it, and I'm going to buy more as the price starts to move up, which maybe it doesn't sound like the right thing to do, but we have a long way to go up after, if 200 is that level of support, which it could be, and if it is, then I'm going to have some shares there, but I'll buy more as it starts to bounce back up once we have confirmation that the market is recovering.
Awesome. Does
Yeah.
anybody
Brennan?
else have any?
Yeah, I got you, Vinny. Brennan, do you casually put all your money into one stock, or you never do that? Except like once a blue.
I typically don't. Unless you're playing with a tiny bit of money, like let's say you have $500. Yeah, sure. If you have $500, put it all in on one company, go for it. But no, I mean, this account that I have, I guess, the 130 this year, I would never put $130,000 into a trade unless it was for like milliseconds. If I was doing it for like a minute or two. But I wouldn't generally, you never want to go all in on anything, because if you're wrong, being all in means that you go down pretty fast, and you don't want to see that. So the most I'll usually put into a trade typically is anywhere between 15 or 20% of my total account, which is still pretty high.
And how liquid are you right now, percentage-wise?
I'm about, like today, like right now, in my trading account, I'm about 70% liquid.
You never put more than 20%?
No, you can. It's just case by case. I don't want to give you incorrect information.
I got you.
Like there's some times where I know without a doubt the price is gonna move up, right? Like let me give you an example of something that happened recently that you can put all your money into short term. Like Disney announced that they had 150 million subscribers of their like Disney Plus thing. You know what I mean? Is that what it's called, Disney Plus?
Yeah.
Yeah. Okay. Yeah. That news guaranteed was going to move the stock up. That's huge, massive revenue, huge numbers coming in. That was going to move the stock up, right? So, and maybe in that sense, as soon as that news gets dropped, if I'm early and like that got dropped 10 seconds ago, I could go in and buy, and I could put 80% of my account in it because I know it's going to go up, right? That news tells me it's going to go up. And then, as it starts to buy, and the price starts to move up, then I'm going to sell into the new buyers. That's a trade, right? That's not an investment. That's a trade. I'm doing that all within an hour or a couple hours. But the key is getting that news early, right? Because let's say Disney announced that 2 hours ago, and now the price was 100, and now it's 120. And you're like, oh my God, it went from 100 to 120. You got to realize there's a ton of people that bought between 100 and 105 that are pumped to sell it to you at 120. So that 120 is a bad place to be a buyer. That's actually where you would be a seller. which is, like I said, counter to what you would think, because it went from 100 to 120. You think, oh my God, this is going to the moon, but it ain't, because there's a lot of people that are wanting to sell it because they just got 15 or 20% gains within an hour or two.
Is there a way where you get the information earlier?
Yeah, I mean, so once you like really get into this, I actually pay $100 a month for a news alert service that literally pumps the news onto the front part of my screen as it's happening. So like the second it breaks, I know about it, which is how I've been able to get a competitive edge over a lot of other people, because I'm in these trades before a lot of others.
That's crazy. That's dope.
Yeah, but that's like, I mean, that's like, you know, when
That's
you're
down the road.
when you're a super nerd at this. Yeah. What I'd challenge most of you guys to do is not to go into the trading and buying and selling within an hour or two. I would just look for general setups where
you can't really do
buy.
that anyways, right?
Yeah, a lot of you won't be able to anyways. There's what's called pattern day trade restrictions anyways. But I would challenge a lot of you to look for these setups, buy, and then a week or two later, sell, or even hold for a few months. That's going to be the easiest thing to do. And looking at it from a more macro perspective, I'm showing you micro moves, things that happen within a day or two. But if you want to make good money and not have to have it suck the life and energy out of you, think more macro and look more big picture, and buy and sell, weeks at a time, maybe months at a time, is probably the best move. But if I had a 401k or anything where I have a lot of money parked, I would let it sit and just it'll recover. Nothing to worry about. If anything, I'd be doubling down. But I'm purposely mainly liquid. And if you guys understand what liquid means, because I know that's a term that when I first heard it, I was like, the fuck does that mean? Liquid just means that how much cash are you holding? So Vinny basically was asking, how much cash are you holding? And I told him 70%.
Which is a ton to be holding right now.
Ton, yeah. I mean, that's just how bearish I am. Yeah, I just think we're going to go back down. So I don't want to be holding a bag.
Awesome, man. Well, does anybody else have any questions for Brennan?
Yeah, I got a quick question. It's actually a little bit of a different topic, but Brennan, I know you talked about like possibly buying some investment properties. Something makes me curious. I was just wondering if you're still like going to do that, and just what your game would be for that.
Yeah, so surprisingly, the real estate market, maybe not surprisingly, but the real estate market hasn't fallen off like it did in 2008. I mean, literally in 2008, like $1 million house, you could have purchased for $550,000 or $600,000. I mean, you literally could have back then you could have got 40 or 50% off real estate. Right now, we haven't even really seen that big of a drop in the market yet, real estate wise. I still think that's coming. I think that's going to be one of the more of the delayed things that we're going to see here, because I think that once we open up the economy, things get back up and rolling. I think everyone's very excited and they think that, oh my gosh, the markets are going to recover. I don't. I think we're going to see another low. And I think once that second low hits and real shit starts to hit the fan, that's when I think the real estate market is going to actually get trimmed up a little bit. Right now, I mean, the government's doing all sorts of stuff to help people. Like, there's no evictions happening right now. Like, they're letting people put off their mortgage payments. I mean, all sorts of assistance is helping out people that own real estate, which is why you're not seeing a really big drop in the real estate market. So I am still planning on purchasing real estate, but I'm still not doing it until I get confirmation that the market is on its way down. Once it's on its way down, then I'm going to be a big buyer in real estate, Jackson. But right now, I'm not. So just my personal plan is I'm trying to take this trading account that I have that I showed you guys. I turned 15,000. I got it into 130,000 by the end of the year, or maybe a little bit sooner than that. I want to turn that 130,000 into $1 million. And with that $1 million, I'm going to purchase real estate because I think that's going to be the timing of the market going down. And what's cool is that if I'm able to do it from my trading account to be able to do that, the way I'm going to look at that is a bunch of free real estate because that's money that I'm not actually even taking from the savings or places that I have other money parked. That's just money that I've made in the market. So that's one of the big advantages of trading. that I'd really encourage all of you guys to start learning and understanding, just because you can really get a competitive edge when the markets aren't doing well. I mean, the markets, are down, I think 10, 15, 20% year to date. And, I'm up 300%. And the only reason for that is that I just have a different skill that a lot of other people don't take the time to learn. But like I've told you guys, it's like learning another language. You're not going to get it in a day or two. Just because you can say hola, como estás does not fucking mean you know Spanish, right? You know some parts of Spanish, you know a couple things, but you're not fluent in the language, right? And so to be fluent in the language, you got to learn it, you got to study it, you got to practice it daily. And then maybe after a year or two of doing it every single day, you'll have the language down. Trading works the exact same way. And once you know what you're doing, it's a lot of fun. I mean, I really enjoy it. I spend most of my days doing that. But last week, I think I shared it with you guys on the call. Last week, I made $30,000. Last week, you know what I mean? And that's insanity. It's totally insanity. But one of the advantages for me during this quarantine is that I've been able to take up another little, hobby or thing that I enjoy doing, which I'm not normally able to do when I'm running the business day to day, is trading. So, my business isn't making money, but that's no excuse to not be able to make money, because there's another skill, another tool that I have in my tool belt.
It's incredible.
It's one that I'm very excited to teach you guys. And that's why I'm wanting to see a lot of you guys get to that next level financially. Because if you can run a profitable business that makes great money, and you know what to do with that money, and you can put it in places that it's going to go make you more money, I mean, that's how you cash out. I mean, that's how you guys are all done working by the time some of you are going to be, Jackson, I think you're 20 or 21 years old. I mean, I can literally look you straight in the face and tell you that if you do this, by the time you're 30, you could be in a position where working is going to be completely optional for you because you just have made sound financial decisions. And I know that's hard, especially when you're 20, 21, because you're making money, you want to party, you want to buy a nice car, you want to do all this shit, and that's cool. There's nothing wrong with that. It's just the more you can live like a broke ass college kid through your 20s, when you're not married, you don't have kids, that's going to, if you're really good with your money, you could set yourself up so that by the time you are married and you have kids, you're going to be there every single day with your family. You can take your kids to the best doctors. You can travel the world, and you'll be around. I mean, and that's what I want to do. I'm not married, don't have kids yet, but I certainly, when I get to that point, want to be in a position where working is optional. I do it for fun. And, I don't have to miss Johnny's soccer practice or baseball practice because I got to go work. I want to be there. And, our education system just does a really piss poor job of educating our, people around finances and money. And I think our business does a great job of that. And it's an area that we can get better in. But, I want to see you guys get to a point where you guys can all become, owners. You can be able to run a market, make a lot of great money. And then, there's a whole nother formula I'll have for you in teaching with, what you can do with your money and how we can all win big together. For me, that's what it's all about.
And you could also look at it this way. Imagine if you took that $15,000 that you originally had and you bought like a car or a depreciating asset with that, right? You would have nothing left. It would be worth zero by this point. Instead, you turn that $15,000 into $130,000, right? Up 300%. You would think if people knew this, they would do it. But you're right. It's not taught. It's not taught in the education system, in the public school system. And unfortunately, that's a big problem. That's why we're so lucky to have, you, Sebastian, these people that have done really well in the markets teach us exactly, how to become financially free and independent. So yeah, man, I really want to thank you for, taking your time out of your day and teaching everybody exactly how you're doing what you're doing, because it's really incredible. Not a lot of people can say, they're up 300% right now in this market. So thanks again. Yeah.
It's with little risk too. And one would think that it's with a lot of risk. It's not. It's just you got to have a plan when you go into your moves. And if you're wrong, but be wrong barely. Don't be massively wrong where you buy at 50 and you sell at 25 and you just lost half.
Exactly.
Be wrong where you buy at 50 and, oh shit, it hit 49 and you sell at 49 and figure out another plan. You know what I mean? But too many people do the old stay and pray. They buy and then pray. And that's unfortunately not a very good strategy if you're wrong.
Absolutely. Well, in times like this, the rich get richer and the poor get poorer. So hopefully we can be on the side of the rich and, learn from you. So does anybody have any other questions from Brennan, or we can wrap this up?
I got one more, actually. I don't mean to be a pain in the ass.
No, it's Sunday, man. I got nothing but time here. Markets are closed.
I wanted to ask you, when you invest in a stock, right, and it's a reliable company, a company you believe in, and you buy it, say for, I don't know, say it's like for $60, and it's only at 60 because of the virus, right? So we had a huge dropout in the stocks, and you know that, I don't know, say a year ago it was up like $150. Is that a stock you're going to hold on to even if it continues to drop under the 60 you bought it for, or are you going to sell it as soon as it goes up and it breaks through that wall to like $80 or $20? I mean, like $20 profit on it. Are you selling it, or are you still holding on to it, knowing that it's like a year ago it was up 150 plus?
Yeah, it's a great question. And what I would say to that is it's totally case by case. For instance, like what Vinny was talking about was JCPenney, right? You know, JCPenney at one point was, you know, almost, I think, $50 or $80 a share. I got to go back. I can show you the chart. And today it's at 28 cents. So sometimes yes, Mike, and sometimes no. It depends on what's actually going on with the company. And is it just a drop because the overall market is dropping, but nothing fundamentally has changed about the business? Or has something actually changed with the company that could cause it to actually be, you know, a company that does not have as much value as it used to have? So it's case by case. So let's just say, for instance, we'll take Vinny's example with Boeing. Vinny's really big on Boeing. I am big on Boeing, but not as big. Vinny, I think Boeing was at almost 400 a share at one point. Is that right?
Yeah, $400.
400. Okay, and then it went from 400 down to 90. I think is what it hit at its low, or 88. And I think today we're back up around what are we at? Like 120, 130?
Yeah, 130, something like that.
Okay. So I think buying Boeing, for instance, right now is not a bad move. I think it's going to move back up to 250. I personally don't think Boeing is going to get back to 400 a share, because I think that there are some things that fundamentally have changed about Boeing, which will make it less valuable. I think they were wildly exposed during this time because they were irresponsible with some of the money they had. They had some of those issues with the 737 MAX, which was crashing. People in general are not flying as much right now, which means a lot of these airline companies will not be flooding to purchase more airplanes. So I think if it does get back to 400, it's going to take a very long time. However, I do think it's probably a company that's worth about $200 to $250 a share, which right now I would be a buyer in I'd be a buyer right now. But where I wouldn't be a buyer is, let's say, a year goes by and they're up around $250 a share, or they're at 250, 200, 250. I don't know if I'd be a buyer there. I don't think I would be. But I think right now, I think you're in a good place to buy. So it's not wrong in thinking to buying Boeing. I just think fundamentally, I don't think they're getting back to 400 a share. Personally, that's just me. That's my opinion and my thought, because there are some things that I think have actually changed with the company. So the sell-off, I think, was warranted. They did need to drop. I think it's too much of a drop, which is why right now is probably a good time to buy.
What about if they get approval from the FAA, for the 737 MAX, once the airlines start purchasing airplanes again, then you would see potentially another rise in Boeing?
Yeah. I mean, from a long buy and hold perspective, I think in the next 5 or 10 years, yeah. But I just don't think you're going to see in a year or two it's going to snap back up to 400 a share at all. I think that's much more down the line. I think Boeing was a little overvalued, and I think this whole epidemic kind of exposed some warts that they had, some open wounds that got really exposed here. So that's why I think fundamentally I don't see the correction back to 400 a share. But I do see for sure a bounce, 200, 250, no doubt. So buying right now is not a big deal. And if you're putting it like in an IRA, like what Vinny was talking about, if you have a Roth IRA and you just want to buy something and let it sit there, or a 401k and you're just going to let it sit there, buying Boeing right now is a total no-brainer. But if you want to buy, you want to be in and out of it within a few months or a year, I think there may be some other places that you can look to make a little bit higher of a return on your investment. But Boeing certainly is a great company, a great American company, been around for a while, and it's not going anywhere. So it's a pretty safe investment, I would say.
Would you buy Macy's right now for $5 a stock? I mean, I know Sebastian said something about how he thinks that that's like one company that he believes is going to go back up as soon as this is over.
Yeah, retail is tough, man. Where I would most likely be putting my money, if I'm going to invest anywhere retail-wise, Mike, I think I would actually be looking to go more towards discount retail stores. So think think Five Below, which their ticker is FIVE. Think TJ Maxx, which is TJX. Think Big Lots is another one. Because what I think is going to happen is we're going to hit a recession, where we already are maybe potentially in a recession. I guess not by definition, but we will. And when that happens, people get a lot more conservative with how they spend. They're not just going to go out and just spend crazy amounts of money. People are going to be looking to save money. So I think maybe a customer that was maybe buying clothes at Macy's once before, I think now their first stop is somewhere like Marshall's or TJ Maxx before going to Macy's. Because Macy's, you're paying top dollar, premium dollar. I don't think Macy's is a bad investment. I think it will go back up for sure. I just think maybe some of your higher returns are going to be on some of those discount retailers, because I think people that wouldn't normally shop at those discount retailers because they have money, so they go other places. But I think as money gets more tight for a lot of Americans, I think people are going to go more towards those discount retail stores.
Awesome. Thank you.
Yeah.
I have a question for Vinny.
Walmart stock continues to go up, Colleen. They're killing it right now.
Oh, I didn't even know that. I was kind of just joking.
No, great. They've actually been one of the best investments through all this, because they're one of the only places that's staying open, and their numbers are still really good. So if you were a buyer of Walmart, you'd be a happy camper. They're doing great.
The same thing with Amazon too, right?
Yeah, Amazon's hitting all-time highs, and no surprise there either, because more people are buying online because they don't want to go out and leave their house. So yeah, I mean, as soon as, believe it or not, even though Amazon was rocking and rolling this year, believe it or not, as soon as the coronavirus hit, a good place to probably put your money if you were thinking the right way would have been putting it into Amazon, because you would have been like, oh shit, we're going to get stuck at home, and then more people are going to buy from Amazon. So believe it or not, Amazon still was a really good buy at the beginning of the year, or as soon as you heard about the coronavirus, that would have been a good time to buy. Funny enough.
Netflix
Okay.
as well.
I have a
too.
question for Vinny. This is more around the Roth IRA and kind of more like stable investing, I guess you can call it. You said, should you max out the 6,000 and then move into your individual account?
Yeah, that's a really good question. So the Roth IRA is super important because, like I said earlier, it's tax-free. So your money that you've made from your job, you've already paid taxes on. So what you want to do is you do want to max that out. You don't have to max it out first before going to your individual account. You can do it simultaneously. But what I do recommend is probably doing it on a month-to-month basis. So, maybe like 200 to 500 a month into your Roth, and then you can start investing as well into your individual account. It's really up to your financial situation. That's the most important. So I would look at what you have, from your liquid assets when it comes to cash on hand. And then I would start putting money into your Roth and then investing into your index funds.
Okay.
Does that answer your question?
Yeah, I put quite a bit of money right now monthly into a savings account. And as I listen to this, I realize it's probably really stupid. So I'm just trying to figure out a better system to do. I just don't really know what to do.
So yeah, you're right. Having all your money in a savings account right now is a bad idea. I still have, like 30% in a savings account because like Brennan, I'm waiting for, the prices to get a little more attractive. So then I can start purchasing more of SPY, more of these index funds to lower my dollar cost averaging. But what you can do is if you want to max out your Roth, you can go ahead and do that, but you don't have to invest right away. You can just keep it as cash in your Roth if that's better for you.
Okay, and then would you say right now is a good time to open a CD just for the time being to kind of wait for the market to pick back up?
So for a CD, if you can find one for 3%, God willing, then yeah, that's pretty good. But at my bank, I'm banking with Chase right now. The best one I found was like 2%. So I'm not really interested in CDs just because it's not enough money, to make on what you're actually putting in. But if you want to just get a quick 2%, you can do that. But oftentimes you have to hold that money for about 6 to 12 months, depending on the maturity of the CD. So just keep that in mind, how long you want to hold that money there, because at this time, I think it would be better for you to stay liquid. That way you can start purchasing assets.
Okay, thank you.
No problem.
Yeah,
I love the
example Vinny gave about the 15,000, right? Like if I went and bought a Honda Civic for 15,000, you know, if I needed to sell that Honda Civic today, I mean, I'd be lucky if I got $11,000 or $12,000. I would have lost $3,000. Cars are depreciating assets, which is why, you know, I only have a brand new truck because people were giving me shit and they were like, I don't know if you're really actually making money. So I was like, all right, fuck you guys. You know, I'll buy a fucking $70,000 truck. But really, it's not a smart investment, which is why I'd rather be really wealthy and not look cool than to look cool and to be broke off my ass, right? There's something really nice about going to the store, and I'm not making my purchasing decisions at the store based on the price. I'm making my purchasing decisions based on what I want to eat, what I want to drink, what looks good, you know, and I throw that in the cart. Whereas, you know, and some of you are living a life like this where, you know, you really got to check your accounts, you got to compare pricing, you know, living a life where money really isn't factoring into your day-to-day is a lot more of a stress-free life for a fact. And so the quicker you can learn and become financially literate and really start to understand how money works and assets work and appreciating assets, making money, and developing a skill, these things will pay you back for the rest of your life, which is why I love, you know, sales, for instance. You know, you guys all quit working with me tomorrow. All of you are more than qualified to go get a job somewhere and do sales because of the things that I've taught you, right? The skills that you guys have learned will go with you forever, and no one can take that from you. So investing in your own education in terms of, you know, financial literacy is the same thing. It'll go with you for the rest of your life, and something that, you know, once you learn it, you know, you're going to be good. It's just that hurdle of initially learning it is what stops most people. That's the whole reason why I don't speak 8 languages. I'd love to speak 8 languages, but if I'm being honest with you, I don't have the discipline, desire, or toughness to learn 8 languages right now. I just don't, which is why I don't speak 8 languages, right? I only speak 1 and poquito español. It's about it. So financial literacy, I think, is totally worth your investment and something that I would definitely spend some time on. And I would just get, you know, stock market for, you know, for entry level, stock market for, you know, beginners, and really start to learn the basics, because like I said, it's a skill that will go with you for the rest of your life.
100%. Does anybody else have any questions for Brennan?
No, this was really awesome, though. I appreciate
No more
it.
questions. This is good.
Yeah, it was
Awesome. Yeah, I really enjoyed it, honestly, Brennan. You taught everyone a lot. So we can do this again maybe next week. Just let me know when you have some time. You know, we'll set it up.
Weekends are good.
Like, we can just make it like on Sundays. I mean,
Yeah.
everyone's pretty much like relaxed on Sundays.
Perfect.
Yeah.
All right, cool.
great.
Yeah, let's do Sundays.
Let's do it.
Cool, guys. All right, yeah, you guys have a great day. Thanks, Brennan.
Thank you, Brennan. Thank you, Brennan.
Appreciate it. Have a great day. See ya.
Take care.
All right, no tennis. It's raining.
Yeah, it's pouring.
See you guys later.